Market's slipping a little bit, but maybe we're getting greedy here. Let's talk about this with Phillip Shaw, Senior Advisor, Goldstone Financial Group, goldstonefinancialgroup.com. Hi, Phillip. Welcome back.
Hey, thanks for having me, John.
So what's the market doing and why?
So I think we started to see a little bit of a pullback in the market, but it's nothing we're concerned about quite yet. As we have these, bull market cycles, we're always going to have temporary breathers where the market, tries to digest what's happening in the world. We just had a Fed rate cut. What is that impact going to be to the economy? We've got PCE coming out tomorrow and some other job inflation data. So I think this is just the market digesting. It's not a move that worries us yet at this point.
Well, particularly if you just draw your graph out far enough, go farther to the left. I mean, it's been a good year, right?
Well, it's been a great year. We have S&P 500 up 12% year to date. Dow's up just over 8% year to date. It's been a good year, and from what we've seen historically, this is a pretty typical, what we'd see in a third year of a bull market.
How long do they usually go? Is it a 5-year run? What's a typical bull market?
Well, you can expect this kind of 5 to 7 year run of a bull market. All of them are going to be different with time. Obviously, we had was that a 14-year bull market, the last major run up when we had from 2009 through 2022. We had an exceptional run of a bull market. I don't know how long this will be. I think we've got some room left to go, but we'll see as the world moves forward.
Did I sense a little caution in your voice around the Fed? I thought 25 basis points with 25 more to come, and who knows what next year. That's a good thing for the market, right?
Oh, I think the Fed first rate cut's a great thing. We'll see how data dependent they feel the remainder of this year. Our take is that we'll see one more rate cut, probably towards the end of this year, whether that's the next meeting or the following. I was actually optimistic to see that it was only a 25 basis point rate cut. You and I talked about it a little bit before of, if they'd done a 25 or a 50. And the downside of doing a 50 is it tends to be an indicator of a coming recession and the Fed being concerned about weakness in the overall economy.
Yeah, right. Well, it would have, I don't know if it would have felt like a panic, but it just didn't seem necessary. But it also appears, right, that they are more worried about employment than inflation, that we could take a 25 and then another 25-point hit.
Oh, I definitely agree. I think some of the inflation we've seen is the start of tariff impact to the overall economy, and that the general baseline inflation's been pretty well tamed at this point. And I agree with you. With unemployment ticking up a little bit, we had a pretty significant jobs revision here recently, about a month ago. I think the Fed is starting to lean the other side of their dual mandate, which is worry a bit more about employment than inflation at this point.
Yeah. Are we going to continue to get the jobs report the way we used to? What are you hearing about that?
So the concern right now is if we have a government shutdown. If we have a government shutdown come here, that's going to be probably a delay on where some of the numbers are coming from. I would anticipate the jobs numbers long term, we'll still see them the same way we have in the past, ideally with a little bit less in revisions. Maybe we can get some better technology or better reporting in the departments that will get us some better clarity on job numbers. In the short term, I think you'd only see an issue if we had a government shutdown.
There's nothing suspect about the jobs numbers, though, for July and August that were revised significantly downward. There may have been a number of factors that led to that, but I mean, apples to apples, this is the way it's always been done. Not everybody complies right away with these reports that businesses file. If they're stressed, maybe they've got other things to do other than fill out a government form. Then the revision comes in when more data comes in. I'll take your point that the ability to predict based on a small data pool is pretty bad right now. I'd like to see them get better at that, but I don't want to just ignore those numbers. I don't want them to stop releasing those numbers. Do you?
No, I certainly want them to keep releasing the numbers. I think that's crucial to understanding, where the economy is. It's a huge data point for the Fed, and you're right. I don't think anything suspect about the fact that we had a revision. It was a bit larger than what we'd seen in the past, but that could have just been exactly what you're saying. That could have just been, we had stress and other priorities and we weren't able to get good numbers in a timely fashion. I don't think there's anything suspect about it.
Well, if you're predisposed to find conspiracy everywhere, then there you would find it, because it wasn't just a little revision. It was stunningly revised, wasn't it?
Oh, it certainly was. Almost a million jobs difference is a pretty significant revision. We don't see revisions of that size very often. And to your point, yeah, if you're looking for conspiracy, you'll find it anywhere you look. The internet's a big, wonderful place, and you can find an opinion about just about anything.
Gross domestic product, though, there's some good some good news there, right? The GDP.
Yeah, overall, we've seen a lot of strength in the economy. It's nothing that we're not going gangbusters about, a ripping economy, but we've seen some really good growth come out of, the last year here, and we're optimistic about where this is going forward. I don't think we're headed for a recession or any kind of a major pullback. I worry a little bit on the employment.
On the employment, that is, if there is continued unemployment, if that number continues to go up, then what happens?
Yeah, I worry about the continued unemployment. I think that would just lead to a couple of additional Fed cuts. But if we see a significant amount of AI being implemented, that may also be feeding into potential unemployment numbers. But at the same time, this is historic lows. 4.3, 4.6% on unemployment. I think if you asked anybody 20 years ago how they'd feel with a 4.3 or 4.6 unemployment rate, they'd say the economy's doing incredibly well. These numbers used to be 7 and 8%, and we called that full employment.
Yeah, right. Ask somebody 10 or 20 years ago, what do they think about 46,000 on the Dow? You'd have to pick them up, wouldn't you? It's funny how some of the numbers are, I think, sometimes better than we fully appreciate. I'll ask you more about that in a minute. Phillip Shaw, Senior Advisor at Goldstone Financial Group. I want to talk about housing as well. And what are you telling your clients? So are you still sufficiently bullish that everybody's going to stay in equities? Chatting with Phillip Shaw, Senior Advisor at Goldstone Financial Group. Phillip, let's just talk a little bit about the housing market for a minute. Do you have any predictions on maybe lower rates are going to eventually unlock some of the buying opportunities that are still out there?
I think we'll start seeing lower rates unlock that, but not yet. Until we get at that 5.5% range on a 30-year fix, I think a lot of people that are locked into their mortgages, sub 4%, are gonna stay right where they're at. We had new home sales looked great. Existing home sales, recently were a bit muted. And I think that's emblematic of the fact that so many people have these low mortgages. Obviously we just had a Fed rate cut, and we haven't really seen that impact the 30-year fixed rate, but another rate cut or two, and I think we'll start seeing that impact, and then start seeing the housing come with it.
Yeah, it's hard to see 3% on a 30-year fixed is a bad thing. But maybe we shouldn't do that anymore because it's just kind of stalled then, the whole housing market.
Yeah, the 3% 30-year fixed rate. I mean, there's an opportunity that, if you're able to take advantage of it, it's incredible. But, as a long term for the economy, it's not a great place for us to be at. Reality is the Federal Reserve treats interest rates as a really great way to pull the economy out of a recession. And in a typical recession, they lower 2 to 2.5% on the overnight rate, the Fed rate. And if we're already at 0 or 1%, the environment we were at to have a 3% 30-year fix, there's no room for them to go anywhere. Yeah. So it was an awesome opportunity that we had. I don't think it's a good position for us to be in because we have no ability to play defense.
That's a good point. What are you telling your clients then? Are you guys still pretty bullish?
Yeah, I think we're still in the middle of a bull market in equities right now. I still worry about, we're starting to see a little bit of bubbling in the AI trade, not necessarily in the biggest players, but in a lot of the smaller companies where we're still giving these, multi-billion-dollar valuations, and they don't necessarily have revenue yet. I worry about a little bit of that feeling like the '08, or sorry, the 2000 .com bubble. I don't think we're at a concerning point yet, and overall probably still in the middle of this bull market.
Yeah. If this whole thing comes crashing down, and I don't mean crashing, but if it comes down significantly, if we have a whopping correction, I'll say, and then we look back and go, well, it was the AI bubble, you guys. When are you going to learn? It happened with the internet. It happened with the housing market and 110% mortgage loans. You've got tariffs that are still floating out there. We haven't felt the full freight of that. So I'm just wondering if there's going to come a moment where we're going to look back on this and kick ourselves that maybe if you are in retirement or near it, you didn't transition yourself to very secure things because this market just can't last. That's my best case, worst case scenario. I wonder if that's a worry that you have or that I should have.
I mean, it's always a concern for us, but that's where the long-term planning comes in place with our clients. If you're going into retirement, most people, if you're 60, 65, even 70 years old, you're planning for 20, 25 years of a retirement. There's still a good case for having money in the market for the long term and not trying to time the market. You made this point about if you told someone Dow 46,000, you have to pull them off the floor 10 years ago. I agree, and we'll have the same conversation probably 10 or 15 years from now. It's the short term where you need to have a lot better protection.
Yeah.
You need to make sure that walking into retirement, where the next 5, 10 years worth of income is going to be coming from.
And should that be cash? Like, I wonder what you tell people going into retirement, particularly right now where things are so good. I wonder how much money they should have at the ready so that they don't have to sell off their assets.
It depends on how much they need, and then a lot of that is into individual bonds. I think with the spread between corporates and treasuries, I tend to lean more on putting treasuries into that. Money market rates are still pretty attractive, and just making sure you're at least earning something on it while it's sitting. But if it's the first 2-3 years, right, worth of your retirement income, that really shouldn't be sitting in the stock market. It's just too volatile. You're too exposed, and most people don't want to move their retirement date because the economy fell or because the market fell. Most people are planning their retirement around a time in their life, not a time in the market.
Hold on, I'm writing that one down. Most people are planning their retirement around a time in their life, not a time in the market.
No, absolutely. I don't think I've met a single person who said, Phil, I'm going to wait to retire until the Dow hits 47,000. It's I turned 65 and I can get on Medicare. I turned 67, I can get on Social Security. Like these are the dates that people are planning around, and you don't want to move your retirement 2 or 3 years because your market, because your portfolio took a hit.
So that my friend Terry Savage won't call you up and start yelling at you. Do you suggest that people take Social Security early?
It's a decision. There's two sides to every financial decision. There's the dollars and cents, and there's the what works for my life and my personal situation. If you're going to live a long life in retirement, you make it into your 90s, there's a strong case for waiting until you're 70 years old to start drawing Social Security. If you have a difference in ages between spouses, there's a strong argument for somebody taking it early. I'd say all of it's personal to you.
Phillip Shaw is the senior wealth advisor over at Goldstone Financial Group, goldstonefinancialgroup.com. Nice to talk to you today, Phillip.